welcome to SMC FX. In today's video we're going to be covering POI selection. So at SMC FX there's a few rules that we need to follow when we are selecting our POIs. First off, we want to break a structure, then we want to leave imbalance, and then we want the move to be impulsive. So let's start off with swing and intraday POI selection. Now on the left you can see a higher time frame demand zone. We have broken structure and prices come back down and tapped into the demand zone here in this circle. Now when we look into this area of the higher time frame demand, we are looking for something similar to this on the lower time frames. So what we're looking for is price coming down, creating a lower low, pull up and a lower high, and then we want a break of structure. So to start with, this where I've marked chalk would be a break of structure into the higher time frame demand zone. Okay, so at that point we'll be marking this as a break of structure if that occurs. Now when we get the break of structure of the lower high, this is when we can confirm the chalk. And then what I do, I mark both this as a chalk and this as a chalk, but this is just a standard break of structure. But we need this break of structure followed by this break of structure to confirm this as a chalk entry model. Now when we get this chalk here, we are looking at the lower time frame demand zone that is created within the higher time frame demand, and that's where we're going to be looking to enter. Now we are looking for all our rules to be met that we mentioned on the previous slide. So back over to the higher time frame, we want some imbalance left in here, so we want a reason for price to come back down into this demand zone. We want this to be a break of structure, and we want this move to be impulsive. And we're looking for the same things on the lower time frames. Okay, so when we have this break of structure here, which has created the chalk, we then want some imbalance above the lower time frame demand zone. We want this move to be impulsive and we want a clean break of structure, and that's when we'll be looking to enter around here. Now this entry model is very similar. Now if you have watched the inducement video, you'll recognize this as an inducement entry model. Okay, so similar thing, we have the higher time frame demand zone created just here, and within this area on the lower time frame we'll also be looking for something similar to this. So a push down into the demand zone, we are then creating a range, price is consolidating. Now we could have a lower high around here and a break of structure from this, but this isn't always necessary, but it is favorable. But what we're looking for is a sweep of the liquidity on the sell side. So we sweep the sell side liquidity, tap into our demand zone on the lower time frames, and then we are looking to sweep the buy side liquidity to head towards our targets. So here's an example on the charts. So what we've got here, we've got a higher time frame supply zone. Now this is on the 1 hour. Okay, we've had our break of structure. It's not the nicest break of structure, but it would do for this example. Price is pushed down. We've then had a weak break of structure here as well, but what we're looking at is when price comes back up to this demand zone, we've got a little bit of imbalance just here, and this part has been a fairly impulsive move here. So this meets our rules. We've still got some imbalance need clearing, so we've got a reason for price to tap back into this supply zone. Now let's drop down to the 1 minute or maybe the 2 minute. Let's have a look, see which is the best one. I believe on this example it is, let's have a look on the 3 minute, 2 minute. So there we go. The 2 minute is the cleanest for us on this example. Now this is what we want to be doing when we have this, when we have a higher time frame mitigation. So we have this sort of price action here at the moment. Now we've got our break of structure, which is then confirmed as a chalk when we have this break of structure here. Okay, now when you have something like this and you're a bit unsure of which time frame to use, I use the 1 minute to the 5 minute. So I use 1 minute, 2 minute, 3 minute, and then the 5 minute, and I'll just cycle through them to see which one looks the cleanest. Now when we're on the 2 minute here, we've now got an inside bar, which makes this POI for us a little bit more favorable. On the rare occasion, I may drop down to the 30 seconds or the 15 seconds, but that's rare. It's not very often I'll do that, so you don't need to worry about dropping down to these time frames if you can't. Now, we've tapped into our higher time frame POI, our supply zone. We've had our change of character or our chock. Now what we're waiting for here is then price to come back up to our zone. We've left some imbalance here. This hasn't really left imbalance because you've had a strong wick, and this is then pushed further down, but we are leaving some imbalance down here, so we're giving ourselves a reason to be looking for the markets to come back up to this area. And again, a little bit of imbalance just here as well, but it's not the best, but there's still something there. Okay, so we've covered this scenario where we've got a higher time frame mitigation, we've had a lower time frame entry model. Okay, but what we're now going to cover is this example. We've got two demand zones, both of them are valid. Okay, and I get this question quite a lot. My POIs or my zones are not holding up, and I have a simple way of looking at this. Now, when you get a higher time frame demand zone or a supply zone, just push straight through. Okay, we're just simply going to look for a lower time frame entry model on the next one, providing we are still following the trend of the market. We're still following the bullish order flow or bearish order flow if you're looking for short trades. So, higher time frame. We've got this situation going on here. We've got our two valid higher time frame demand zones, but the top one, or we call this the decisional, and this one we call it the extreme. This is the decisional, which is the one that's caused our recent break of structure. Now, when we look at this area on the lower time frame, we may get something like this. We'll get a reaction from this higher time frame demand zone. We then get a push up, which is then getting a lot of traders thinking that this zone is going to be a valid area to trade from, and they'll immediately be looking for a lower time frame point of interest to get into, but they're not getting a valid entry model, whether it be a chock inducement model or any of the others that we use at SMC FX. So then what happens? This then pushes straight through, and then when we get down to the higher time frame demand zone further down, this is when we start to see our potential chock entry model. Okay, so we've created our lower low and our high, lower high. We've then pushed back in, had a deeper mitigation into the demand zone. We then pushed up a break of structure, and then we're entering from here. And we could either target the demand zone that failed, or we could then look for a supply zone as our target. So in this example, we've got a higher time frame demand zone, and this demand zone has met our requirements. Okay, so we've got this bit of structure here. Okay, it's not obviously a significant high, however, it's a consolidated bit of structure, and this area has been broken. And then eventually this high does get broken, but not by this demand zone. However, this still meets our criteria as a valid demand zone to be looking for a long. So we've got our imbalance, we've broken this structure, and this has been an impulsive move. Now, as this is a higher time frame point of interest, okay, we are looking at what happens on the lower time frame as we get further down. So price is pushed back down, it's mitigated this zone. And then when we drop down to the lower time frame, we can see we have not had a valid entry model. So we've not had a change of character, we've not had a break of structure to the upside, and prices just continue to push straight through this higher time frame demand zone. So from here, we will either be looking for a demand zone further down, or if the higher time frame has clearly changed its direction, then we will just be changing our bias and looking for shorts instead. So when it comes to scalping, we look at our POIs slightly differently. So as we've covered here, we've got a higher time frame demand zone, and then when we're looking down on the lower time frames, we are then looking at a entry model similar to this. And again, with our inducement entry model. Okay, so if we are approaching a higher time frame demand zone, the rules still apply for scalping. However, if we are in between higher time frame zones, then we will be looking slightly differently at the way the POIs are presenting themselves. So here we have a lower time frame demand zone. Now we have met our rules for both this and this demand zone, so we've left imbalance, we've broken structure, and it's been an impulsive movement. However, this one has then met the exact same rules. So the question then comes, which one do we pick? Now you can look at this two ways. You can either take so if you usually risk 1%, you could potentially have two orders set in place. So you can have a 0.5% risk on this one and 0.5% on this one. So you can potentially catch both moves. That's a little bit risky for my liking. I don't like that. So I prefer to wait for the extreme movement, and I would usually have my order placed here, and I would be ignoring this one because we still have the imbalance and we still have liquidity that needs to be taken for this area to be tapped into, and then we would look to go long. And a very similar situation for this example here. We've got a lower time frame demand zone, left imbalance, impulsive movement, break of structure, and then we have another one here, okay, but we've got some equal lows and we've got some more clear liquidity, and this is where we would look at this as inducement. Okay, so if you haven't seen the inducement video, go back, have a look at that, and you'll understand how we look at inducement. However, this one does meet the same rules. We've broken structure, we've left imbalance up here, for example, and we have still had an impulsive movement. However, we've got more of a reason for price to ignore this zone, come back, take this liquidity, tap into this demand zone here, and then continue long. So here is an example of what we've just spoken about. We've got our breaker structure, an impulsive movement, and some imbalance here represented by this arrow, okay? But then we also have another breaker structure here. We've got an impulsive movement, okay? It's not as strong as the one previous, however, it's still an impulsive movement. We've got a little bit of imbalance and we've broken structure. So both of these zones are valid. However, as you can see, this demand zone here has failed. We've pulled back down. We've cleared the liquidity that's underneath this zone. We've cleared the imbalance here. We've tapped into this demand zone and we've pushed back up. So just to recap, the rules that we look for when we are selecting our POIs: we want a break of structure, we want it to leave imbalance, and we want the move to be impulsive. If you found this video useful, please consider liking and subscribing to our YouTube channel, and if you have any questions about the topic, drop them in the comment section below.